Hey guys, Ronald again here. Today we're going to reevaluate something that I was a fan of until very recently. PlanB's stock-to-flow model for Bitcoin. Why am I reevaluating it now? Is it because we didn't hit 100K and I'm salty because I can't flex on my friends? No. I mean, yeah, but not entirely. The real reason is simple. Because I finally looked into the details beyond what's been popularly in the media and in standard crypto spaces. But before we go on, please remember to hit that like button and consider subscribing if you end up liking what you see for more like this. I plan on going for general kind of finance content, including macroeconomics and stocks and real estate. We're focused on crypto at the moment, but there will be more of that type of content. But without further ado, let's get into it. All right, so why is stock to flow a nonsense idea that you shouldn't pay attention to? And yes, that's a bold statement, but it's, I think, roughly the appropriate degree of dismissiveness that stock to flow warrants. And so to begin, what is stock to flow and where does it come from? PlanB, who probably needs no introduction at this point, wrote a paper in 2019, which I'll link to in the description, called Modeling Bitcoin Value with Scarcity. In it, he introduces the idea that precious metals, namely gold and silver, which he uses to construct his model, have maintained their value because of their unforgeable costliness and low rate of supply. That rate of supply is key to what he ends up going on to argue. Basically, the idea here is that the ratio of the stock, or the current supply, to the flow, or the rate of new supply generation, is intrinsically and deterministically linked to the value of the asset. In the beginning of this paper, he recaps a lot of the basic properties of Bitcoin that make it analogous to digital gold, like its unforgeable costliness and its digital verifiable scarcity, which I'm totally on board with. I mentioned a lot of these points myself in more than one previous video, really. But he loses me when he goes on to directly relate this to Bitcoin's value. As we'll see going forward, he creates a few basic problems for himself as he tries to translate these fundamental ideas, which are solid, into a predictive price model. To quote the man directly, the hypothesis in the study is that scarcity, as measured by stock to flow, directly drives value. Some of you are already starting to see the difficulty with that type of extrapolated supply-side modeling, but I'll hold off on spelling that out exactly until a little later on in the video. Next, our boy goes on to take the stock to flow of gold and silver in the year that he's writing it, 2019, which were 62 and 22 respectively, and then plot them on a graph and run a linear regression using the natural logarithm of Bitcoin's stock to flow metric as the independent variable and the US dollar market cap as the dependent variable. He then goes on to conclude that there is a statistically significant relationship between the US dollar market capitalization and stock to flow values as evidenced by a linear regression, resulting in an R-squared value of 0.95. Those of you who are into statistics already see the pitfall here, but that's a bit beyond the scope of this video, and frankly, I don't know that I would be able to do that explanation at great justice anyway. Okay, that's where this whole idea comes from, to put it briefly. And the problems become apparent immediately as soon as you even dig into the basic concept of what we're discussing here. First, high stock to flow inherently means that new supply has little effect on total supply. He literally says so himself when he quotes Saifuddin Ammous. How do you say that name? I don't know. Amos? Something like that. With regards to gold in his own paper, before kind of glossing over that for the rest of it. One basic thing you've got to wonder then is whether this model even works for the assets that he used to get his Bitcoin model, gold and silver, right? This is the graph of the real and nominal market cap of gold versus its stock to flow. Immediately we have a problem. The model doesn't even work for gold, whether you adjust for inflation or not. Instead, we find that gold has had values of 60 billion and 9 trillion at the same stock to flow of 60. Does that sound like something that means something, right? Note how wide of a range that is. We'll come back to this concept later in a moment. We talk about PlanB's more recent comments about Bitcoin specifically. The adjustment for inflation is important here, as 88% of the variability in gold's value in the last 115 years can be attributed to the depreciation of the US dollar, to inflation, not to its stock to flow. This is looking bad for stock to flow, and we're just getting started. On a basic mathematical level, stock to flow just doesn't really hold up. PlanB gives an equation by which he's building his model, right? Natural logarithm of market value equals 3.3 times the natural logarithm of the stock to flow plus 14 plus 0.6. Remember that y equals mx plus b from high school functions class? Remember how m represented the slope, b was the y-intercept? In words, we were trying to figure out how much the change in x influenced a change in y. Remember, x here is stock to flow. And stock to flow only has major changes in Bitcoin around the halving. In Bitcoin's case, major is a relative term here because, as we said, high stock to flow assets, new changes in their supply don't really make a big difference. So if stock to flow barely changes except at the halvings, where does Bitcoin's volatility come from if stock to flow actually explains the variance in the price? The change in stock to flow is essentially zero at every price except the halving. So why does it fluctuate so much? PlanB would probably explain this away by saying that, stock to flow describes average prices over time. But let's take a look at a graph of the change in each variable involved as a function of time. Stock to flow, the orange line here, remains largely unchanged except at halvings, and the price is all over the place. Look at the area of the blue line above and below the orange line. Do the fluctuations in the orange line seem like they explain much of the movement in the blue line? I mean, there's a more rigorous mathematical way of looking at it, but need I say more? You can kind of see it with your own eyes, right? But screw it, let's say more. We're not done yet. Remember when we talked about the wide range of prices possible at any given stock to flow for gold? We see that same problem with Bitcoin. The one standard deviation band for the current cycle is 50K to 200K. Next cycle, it'll be 500K to 2 million. First of all, we're currently sitting beneath the one standard deviation band for this cycle as of January 3rd, 2022. Right? And we're still saying that stock to flow is valid because it's an average? Sorry, dude, I'm not buying it. I'm not buying it. In the next cycle, this range goes from this 150K range I just described to a 1.5 million range that stock to flow would be valid in. I mean, what exactly is this supposed to be useful for? Short-term trading? What on earth kind of short-term bet can you make based on a range this big? Right? Just buy a put on anything in that range? You might as well disregard stock to flow and just use traditional technical analysis. Is it useful for long-term trading? I mean, you might as well just say price go moon eventually and just hodl your way through. Who even benefits from this model, whether it's valid or not? Also, do you remember how he just arbitrarily took the stock to flow at the time he was writing the paper and constructed the model from there? Why is this the place where the model works from? What if we took stock to flow and calculated it from the halvings and just reworked the model from there? As you can see here, we get a very different looking curve from what PlanB's model looks like. It's very different, right? It kind of curves towards a limiting point. It slows down a lot. Yeah, I know, this is a lot of really significant problems, and we're not even done yet. Let's go back to what we said about the problem where he's extrapolating from past supply changes. Most of you have probably heard of the idea that past performance doesn't predict future performance, or something along those lines. It's a pretty popular truism in the world of investing, for good reason. It's simply obvious. And yet, PlanB doesn't seem to have gotten the message. If we use this model to extrapolate out to 2039, we see that a single Bitcoin would be worth $1 billion with a market cap of $20,000 trillion. Now, PlanB's response to all this is basically to say the model only works up to the market cap of real estate. Why real estate? Why that point? Because at some point even PlanB can't stomach the conclusions of his own nonsense model, and that's where he draws the line. But he's waiting for something to say that stock to flow is invalidated. But we already see the problem here, right? It was never valid to begin with. Scarcity is only one variable, and demand is simply too important of a variable to ignore if you want to develop a model that's useful for short-term trading or even long-term investing. Speaking of demand, how does the rest of the crypto market factor into all of this? I imagine a true Bitcoin maxi would essentially say that these are long-term non-issues because we'll all eventually see the light and realize that Bitcoin is the only way. But for those of us that aren't high on meth, let's just allow for a moment that maybe technological innovation is actually important for something that is essentially a part of the tech sector. Not accounting for the way in which other crypto assets divert from the demand for Bitcoin is a huge failing of the model. If Bitcoin were the only game in town, this still wouldn't be a sensible model at all. But the way the altcoin market has burgeoned and actually overshadowed the gains of Bitcoin in the last few years make this an issue that you really can't ignore. Demand is important, and if people deprioritize an asset in their portfolios faster than adoption rises, you need a correspondingly rapid change in scarcity to keep things on schedule. And yet, halvings only occur every 4 years. Look at this graph of Bitcoin dominance and tell me you don't see my point. Okay, now we're done. Look, I think it's really brave of PlanB to just kind of, or any analyst, to just kind of put their models out there in public for anyone to see and open the possibility that, you know, you might get publicly crucified, as he's being right now, when it turns out to be wrong. And, you know, hats off to him for that. You know, much respect. I get that. He seems earnest in his belief here, right? He wasn't trying to mislead anyone or make you lose money. I don't hate PlanB. He just happens to be wrong. Like, blatantly, obviously wrong. Which honestly embarrasses me that I bought into it. And if I'm embarrassed, imagine the dread that he's privately staring down right now. He's been blocking everyone on Twitter who criticizes him even slightly, and to the point where it's becoming a meme on crypto Twitter. And I think I know why. I mean, this has to be really hard for him. Because the thing is, PlanB is not a dumb guy. You know, on some level, I imagine he realizes he's wrong. Maybe just a little bit, he suspects maybe something is off, or possibly even more likely, he straight up has realized all of these same points because people have been pointing these things out to him. I don't think he's able to keep his head in the sand. People don't let him, right? So it's got to be a hard pill to swallow that your model that blew up so much and got you so much fame and notoriety is just fundamentally wrong. And it is. I don't think the answer here is to demonize PlanB. Just move on with your life and get back to stacking sats. And that's the video, ladies and gentlemen. I planned on making this a 10-minute video again, but you know, by the time I was done scripting, I realized I screwed that up again. Sorry about that. I'll get it one day. But for those of you who have watched this far, I appreciate it. And once again, if you got value, please don't forget to drop a like. And if you want more finance content like this, please consider subscribing. If you think I missed something, please let me know in the comments down below, as I do try to reply to all of them. I'll see you in the next one.